Treasury yields were lower today on disappointing retail sales, pretty much erasing what we'd seen over the last 3 days with yields ascending higher, up close and above 270, sort of the midpoint of the 2-month range. So now we're heading back down to the lower band of that 2-month range, the 260 level in 10-year yields. Recall, since January 4th, we've traded in a 260 to 280 range, testing both ends of that range, by the way, and seeing no real conviction when we get to the edges. Market tends to then revert back to the mean, and I think right now we're seeing yields go up slow, and we're seeing them go down a little quicker. So it seems markets overreacting, I think, or reacting more directly to more negative news, whether it be weaker retail sales or some kind of risk in the global marketplace. Those types of trades are being taken more seriously than are, say, if you get strong data or you get maybe a hawkish Fed comment. So right now the market, again, leaning towards the bottom end of that 2-month range. We're not there yet, and certainly expect it to hold unless there's some kind of a catalyst event or news that would push us through, because that would, I think, really start to bring in some big buying and cause some real momentum, upside in price, downside in yield. But right now we're still in the range. And if you look at market volatility is at its lowest levels. We did see a little uptick today, but it's at its lowest levels. You gotta go back to October of 2018. And the market just seems like it's very comfortable here. And if you go back to October of 2018, when we were down here before, market looked much different. We had yields over 3%. We had a Fed that was getting ready to hike in December and possibly 4 times in 2019. And you had an economy that was certainly on the rise, and a lot of positive variables in and around the market that things looked really good. Today, with yields around 265, that's 40 basis points lower. We've got a lot of uncertainty. We've got a Fed that pretty much is out of play in 2019, unless they're going to ease, which I don't think is going to happen. But I think that is pretty much right now, if you have odds on looking at the market expectations, that would be it. And I think that with the uncertainty around Brexit, with the uncertainty around the federal government here, whether there's going to be another shutdown in trade and all that, it just seems like it's a very different look for the market and the world, yet volatility is still very low. So interesting just to compare the two, but vols are low. I anticipate they will go higher as the days creep forward and we get closer to Brexit, which is, the Brexit enigma that we've been hearing about for the last 2 years, more so in the last 2 months, continues as a vote. Again, Prime Minister May put together a proposal and it was voted down again today. So still not a lot of clarity as to how they're going to figure out regulations, rules, trade deals, whatever with the European Union after March 29th, and that hard Brexit that you keep hearing about, which would be very detrimental not only to the UK and the EU, but also to all trading partners, because there would be some major ripples in the financial markets and the capital markets system itself, something that Chairman Powell had hinted at the January FOMC. Also coming ahead, we're going to get the January FOMC minutes next week. Certainly the minutes didn't give us any indication that the Fed was looking to tighten. Actually, they were a little bit dovish. It'll be nice to take a look under the hood there and see if there's anything we missed. There was a press conference. This was the first non-quarterly FOMC meeting with a press conference, and that will continue, in perpetuity here as we look ahead. But certainly, we got a lot of details in Jan at the FOMC meeting. Now we're going to get to see some more details. So these FOMC minutes may not be as intense as previous because we did get that statement. And lastly, the other thing I want to point at is the equity markets right now, which have been booming since the Christmas. We call it the Christmas rally. They're starting to maybe slow their rally. We got to the 200-day moving average. Things didn't push through. I think that right now, if you see a stock sell-off of, say, 7 to 10%, which is what's happened the last 3 times we've reached this level, 2,800 and even the S&Ps, that could be what needs to push Treasury yields through that 260 line at the bottom end of the yield range. So very kind of a lot of tricky variables, sitting very precariously at key points. When we talk about Brexit, we talk about Treasury yields, and we talk about a possibility of a pullback in equities, and that could really change things very quickly. And I think that right now, all of them coming together mean that if you get a hard Brexit, you're going to see equities sell off and you're going to see Treasuries rally. All will and you'll see volatility then need to spike in Treasuries because we'll be outside the range. So some key things to look at here as we move forward. But today, it just seems that we're going to hold the range in Treasuries. Vols are low, so there's no fear of breaking out of that. But like I said, if equities start to make a turn for worst, look for volatility in the Treasury market to bid and look for us to trade outside of that 2-month range.